Hello everyone, my name is Sean and welcome back to Commercial real estate is typically defined as income-producing property that contains 4 or more individual units. This categorization, however, really pertains to how Uncle Sam treats residential and commercial buildings for annual depreciation and tax purposes. But from my practical standpoint, even a single-family home could be considered a commercial investment if its primary purpose is to generate income for the investor. Why prejudice the small investor? I say power to the little guy. So let's continue discussing why commercial real estate might be a better investment alternative to stocks. But before we dive further, let's be clear.
Ways of making money.
Many ways out there. Everybody's got a scheme and angle.
This is not to be taken as financial advice, and you should always speak to your attorney, your accountant, and or a licensed financial advisor before making any investment in either stocks or commercial real estate for that matter. Much of what we'll discuss is nuanced and for entertainment purposes only. With that said, we're going to discuss the 5 reasons to invest in commercial real estate, which are, number 1, there are multiple ways to actually make money. Number 2, it's a great hedge against inflation. Number 3, it can reduce your taxable income. Number 4, the general illiquidity of the real estate market. And number 5, the ability to avoid capital gains taxes altogether. Now let's go a little deeper into these 5 reasons why commercial real estate could be that better investment many of us are searching for. Number 1, commercial real estate provides multiple ways of making money. In stocks, you primarily make money in 2 fundamentally distinct ways. The first is when the stock goes up in value, and the second is through annual dividend payments. And yeah, I know what you're thinking, dividends. Like, who invests for paltry dividend income today, right? No diamond handing ape that any of us know, of course. With commercial real estate, an investor can earn money not only when the property appreciates or goes up in value over the purchase price, but also from the monthly income or cash flow the property generates. Let's not forget that we also have the ability to pull money out of the property through either a line of credit or cash out refinance. We can also choose to do a straight refinancing of the property altogether to reduce our monthly cost of ownership, all tax-free to boot. Since this is really considered debt, the only difference is that it will be our tenants that are ultimately paying back the loan through their monthly rental payments, while we get to enjoy the loan proceeds that were distributed to us tax-free. Now, if we're talking about multifamily or office, we can even condo portions of the property like the retail or individual floors and units, and then sell them off individually. Of course, I could keep going, but I think you get the picture. Real estate investing is super flexible in ways that stock investing just isn't. And now, the number 2 reason commercial real estate could be that better investment alternative. It's a tremendous hedge against inflation in the long term. In real estate, when material costs increase, real estate asset values also tend to increase for new developments and for the replacement costs associated with older assets. And doesn't everyone want to benefit from the appreciation of their own assets? Now, for multifamily in particular, where shorter lease terms of 6 months to a year tend to be the norm, owners can actually benefit during inflationary times by renegotiating and increasing their rental rates with their existing tenants, thereby improving NOI, or net operating income for the property. For the record, net operating income means the income that is left over after deducting from gross income the annual vacancy rate, operating expenses, and taxes for the property. An increase in net operating income will typically result in higher asset values. So inflation can actually be beneficial to real estate investors, super beneficial. But unfortunately for stocks, inflation can actually have the opposite result by negatively impacting the earnings of many publicly traded businesses. As their cost basis goes up, it's not always easy for them to pass along the increase in costs to their customers. Thereby, it can ultimately drag down their stock price. price. So now the number 3 reason commercial real estate might be a better investment alternative is that it can reduce the taxable income of commercial property through a process called cost recovery, or more generally known as depreciation. Basically, an investor in property can take the value of the building which sits on top of the land and amortize the total value of the building itself over a 39-year period, and then take that amount as an annual tax deduction every year for a whopping 39 years. For residential, the amortization period would be more like 27 and a half years, money right back into your pocket every single year. Now, on to the number 4 reason to be in commercial real estate, which is the illiquidity of the real estate market. Although liquidity of the stock market is often touted as the reason to be in stocks in the first place, the downside is that it's super easy to get overly emotional about market turbulence and ultimately sell or buy too quickly. On the other hand, buying and selling real estate does require a considerable amount of work, but has the positive benefit of not enabling the investor to make those rash decisions to buy or sell out of their position when panic sets in, and then to fall into a deep regret later about that knee-jerk reaction they made earlier. Stocks are also much more volatile, and panic selling has been a real serious problem that can almost be eliminated by investing in commercial real estate. And now lastly but not leastly is the number 5 reason to be in commercial real estate over stocks, which is the ability to avoid capital gains altogether. With commercial real estate, an investor can avoid paying capital gains upon the sale of the property. Now, the IRS permits the use of a vehicle called a 1031 exchange. And in a 1031 exchange structure, so long as the investor never touches the proceeds or profit from an eventual sale, and the funds are appropriately transferred to what's called a qualified intermediary, then the investor has 45 days from closing of the sale to identify a like-kind property and 180 concurrent days to close on that property. In this case, none of the proceeds from the previous sale are taxable by Uncle Sammy. You certainly can't do that with stocks. Now, I know there was a lot to unpack today, and I encourage you to watch this video again. Leave a comment or send me a direct message in LinkedIn. That's all for today. I hope you found what was shared valuable and that it helps you to always stay out of the red and in the black.